$1 trillion vanished in 36 minutes. Let's get right into our explainer on the 2010 flash crash.
$1 trillion. Literally, that's the exact amount of market value that just vanished into thin air on May 6, 2010. I mean, we're talking about a fully modern, regulated, algorithm-driven market where $1 trillion of wealth evaporated in the time it takes you to watch an episode of a sitcom. It left Wall Street and regulators completely stunned.
Okay, the sheer terrifying speed of this thing is honestly hard to comprehend. Right at 2:32 p.m. Eastern Time, the market was already trending down a bit because of the European debt crisis, but then the floor just fell out. By 2:45, the Dow plunged 998 points. That is a massive 9% drop. But here's the crazy part. Just 20 minutes later, by 3:07 p.m., the market had recovered almost that entire rapid drop. The whole life cycle of this historic crash was just 36 minutes.
During that chaotic 36 minutes, liquidity totally dried up, and these automated pricing systems became completely unhinged. You had blue-chip stocks like Accenture and Exelon crashing to exactly 1 cent per share, 1 penny. And meanwhile, shares in Sotheby's and Apple, they skyrocketed to over $100,000 each. It was just absolute pricing absurdity. Section 1. Early Suspects and Theories. So in the immediate aftermath, this massive whodunit mystery kicked off. Regulators were scrambling. First, they suspected a fat finger human error, basically a rumor that someone accidentally typed in a massive sell order for Procter & Gamble. Well, that was quickly disproved. Then they looked into technical glitches, like reporting delays at the New York Stock Exchange. Eventually, they zeroed in on the real culprit behind those crazy 1 cent and $100,000 anomalies, stub quotes. Now, SEC Chairwoman Mary Shapiro actually explained how these bizarre stub quotes worked. Basically, a stub quote is just a placeholder price that a market maker posts, like offering to buy a stock for a penny, never actually expecting that order to execute. But when the market liquidity completely vanished, frantic automated orders started desperately searching for any available price, and they eventually hit those extreme placeholders. As Shapiro noted, these automated trading systems are just going to follow their coded logic relentlessly, completely regardless of the outcome.
Section 2. The official SEC and CFTC explanation.
All right, flash forward to 5 months later, to September 2010, the SEC and CFTC released a joint report laying out this very precise mechanical sequence of events. Step 1. A large mutual fund, which we later learned was Waddell & Reed, used an algorithm to sell 75,000 E-mini contracts worth about $4.1 billion. Step 2. High-frequency traders, or HFTs, bought those contracts and aggressively tried to resell them. Step 3. As prices completely plummeted, those HFT computers detected the chaos and just paused trading. And Step 4. With the HFTs retreating, market liquidity completely vanished. Regulators called this exact dynamic the hot potato volume effect, because Waddell & Reed's algorithm was just targeting an execution rate without caring about the actual price. HFTs bought up the contracts, couldn't find any real fundamental buyers, and basically started rapidly selling them back and forth to each other. This hot potato trading spiked the volume while draining actual liquidity, and it drove the E-mini price down 3% in literally just 4 minutes. Section 3. The pushback. Industry and academics respond. Now, as neat as the government's step-by-step breakdown was, consensus fractured almost immediately. The CME Group actually issued a rare press release explicitly disputing the government report. They argued Waddell & Reed's contracts were just a legitimate hedge and that the biggest market decline happened after that firm had already stopped its heavy selling. At the same time, data firm Nainax looked at the raw execution data and pointed out that the algorithm never even crossed the bid-ask spread, meaning it never actually took liquidity from the market. And this disagreement spilled right over into academia too. In 2011, a major study claimed that a metric called VPIN, which measures order flow toxicity, flashed red at historically high levels a full hour before the crash. A clear early warning, right? Well, in 2013, independent researchers strongly pushed back on that. They showed that this supposed historic high toxicity level had actually been topped on 71 preceding days without triggering a single crash. So yeah, even the scientists couldn't agree. Section 4. The Flash Crash Arrest. A 5-year plot twist. Just when the financial world thought this was purely a story of structural market failure, a wild plot twist arrived in 2015. The U.S. Department of Justice arrested Navinder Singh Sarao.
But here's the thing. He wasn't some Wall Street executive. He was a 36-year-old independent trader operating out of his parents' modest house in suburban London. Regulators allege that right before the crash, Sorrell placed and canceled 19,000 orders. That is $200 million worth of bets that the market would fall. And between 2009 and 2015, he reportedly made over $40 million doing this. He pulled this off using a practice known as spoofing. Sorrell basically modified commercially available trading software to automatically place massive sell orders with the explicit intention of canceling them right before they executed. This created a completely false illusion of massive selling pressure, artificially pushing prices down so he could buy the contracts cheaper. He eventually pleaded guilty to electronic fraud and spoofing. But, this arrest sparked a lot of deep skepticism. John Bates from Traders Magazine hit the nail on the head when he wrote that blaming a single 36-year-old trader in a suburban house for a trillion-dollar crash is, quote, a little bit like blaming lightning for starting a fire. Sure, Sorrell manipulated the market, but critics argued the real issue was the algorithmic market structure itself. It was so dry and highly combustible that a single spark could literally burn the whole thing down.
Section 5. Aftermath and market changes.
Okay, regulators clearly realized the market needed a serious fire extinguisher. To make sure a 2010 scenario didn't happen again, they rolled out sweeping structural changes to the national market system. The most famous was the introduction of strict circuit breakers. Basically, if any S&P 500 stock swings more than 10% within 5 minutes, trading automatically halts to let humans and machines catch their breath. Spoofing and layering were explicitly banned, and the SEC pushed for a massive new surveillance tool called the Consolidated Audit Trail to track these hyper-fast algorithmic trades.
And the market organically reacted as well. In the year following the crash, high-frequency trading volume dropped significantly, falling to just 53% of total volume by 2011. The flash crash essentially proved that much of the market's liquidity was just a phantom illusion, computer programs endlessly passing securities back and forth, entirely ready to pull the plug the very second volatility spiked. Ultimately, the 2010 flash crash serves as the perfect modern case study for what legal scholar Jonathan Groper calls the synthetic outlaw problem. It's this fascinating, kind of terrifying structural gap where a computerized system technically complies with all the formal rules and does exactly what it's designed to do, like an HFT algorithm safely withdrawing from the market to protect itself. But in doing so, it produces an outcome that is completely destructive to the wider system. Which leaves us with this final thought for today's explainer. If $1 trillion can temporarily vanish, not because systems failed, but because algorithms did exactly what they were coded to do, who is truly to blame when the next automated market breaks? Is it the rogue spoofer, the high-frequency trader, or the regulators who built the system in the first place? Definitely something to think about the next time you look at a stock ticker. Thanks for learning with us.